Thank you everyone for joining us tonight for another edition of Wednesday Night Live. My name is Jean McDowell and I'll be your host tonight. We've got a great event for you tonight, but the idea of Wednesday Night Live is for TradersCoach.com to host a variety of different educators and trading ideas and present them to you so that you can stay on the cutting edge and then always be learning something new. So we like to kind of look around and find new and interesting people to bring to you each and every Wednesday at 7:30 p.m. Eastern. We bring on a new person and they talk about various topics such as technical analysis, money management, trading psychology, and other things. So I love to get feedback, and anytime you all might have a suggestion or a topic or someone that you'd like to see us have on the program, please email me and let me know what you'd like to see. I would now like to introduce our speaker for tonight, and that's Bennett McDowell. And as many of you know, Bennett McDowell is founder of TradersCoach.com, and he developed a niche in active trading and investing for a community of high net worth clients using his own system, and that system is known as Applied Reality Trading, or the ART system. McDowell brought the ART software to the public in the year 2003, and now today it's used in over 55 countries around the world. Considered an expert in technical analysis, McDowell speaks at many trade shows and traders expos, and he writes articles for magazines like Technical Analysis of Stocks and Commodities. He's also very honored to be included as a member of the eSignal Trading with the Masters. And he also is one of the weekly presenters for the TradeStation morning market briefing every Wednesday. In addition, McDowell has written 3 best-selling books published by John Wiley Sons, and he has a new book coming out by McGraw Hill later in 2014. So without further ado, Bennett, take it away.
Gene, thanks so much. It's great to be here. Just let me make sure everybody can hear me okay and we don't have a hiss going on at this point that I don't know about. So you should be able to, of course, see my screen and so forth and so on. Good. Okay. Thanks, Mark. Good. EB. Okay, great. All right. Well, Gene did a poll, so I think I'm going to do one too. I can't be outdone here tonight. So let me launch this thing and see how it works here. And basically the poll is question, do you have a money management approach or system? And boy, I'm liking this, 42% all the time, 27%, 30%, 29% some of the time, and 26% don't have a money management system. Well, I'm glad you're here tonight, okay? Because I'm going to show you how a money management system or approach can really take a losing trading approach and turn it around for you. So this is good. I mean, 36% are using all the time. Votes are pretty much in now. 44% some of the time, and 20% don't. So let me just close that poll, all right, since we've got what we needed out of that. And we'll go ahead and proceed. First thing I need to cover, of course, is a disclaimer, and we have to realize that there is risk in trading. I think we all know that. But without that risk, there's no opportunity. And isn't that true with everything we do in life? So of course, trading involves risk, but just about everything we do does anyway. A lot of the concepts today we're going to talk about: record keeping, money management, how to put risk on your side instead of against you. So we're going to discuss that as well. Most of these concepts are in a book that I wrote called The Trader's Money Management System. So if you like what you hear today and you want to get a little further information, hey, just go to Amazon and order the book, or Barnes & Noble, wherever you like to go, and pick up a copy. I also have a couple or 3 more books out, actually 2 out and 1 coming out. The first one is The Art of Trading, and this is a book that I first published on the Applied Reality Trading System. That's what ART stands for. Second book is on the Survival Guide for Traders. Purpose of this book was basically how to survive in the current market volatility, and also too how to run your trading from your home, just like a professional hedge fund, a real business, okay? All right, so there you have it. Also, Elliott Wave Simplified is a book that's coming out very, very shortly. So that one should be out by the end of the year, I think. All right, so let me just see here what we've got cooking. I'm I'm getting something from, I think that's Richard Hamrick, clear as mud. Does that mean I'm clear or I'm not clear? So I think I want to make sure everybody can hear me okay, and that kind of is concerning me. So I want to make sure that the audio is A-okay.
I think maybe he's just joking around.
Okay, sound is fine. Okay, fine, good. Just want to make sure. Okay, thank you, Gene. All right, so again, back to our topic, turn a losing system into a winning system. So by implementing a structured and effective money management system, you basically can increase your revenue with your current trading approach. So if you think you have a trading approach that is not doing too well, all right, well, it's good to acknowledge that, but then you have to analyze what's going on with it. And you may find by just implementing a money management system or approach into your trading will turn your numbers around. And so we're going to talk about that today. That's the main gist. But the first question I want to ask many of you is, why do you need risk control and money management? All right, why do you need it? Those that aren't using it, feel free to chime in. If you're not using it, why aren't you using it? What don't you like about risk control? So respond there, and let me just see, all right? All right, Mako says, so you can keep playing the game. Amen to that. Isn't that true? Keeps you in the game, doesn't it? You know, this is not, when we talk about trading, what we're talking about is momentum trading. In other words, we're catching trends in the market, quick moves or pops, momentum in the market. It's not like investing. You know, investing, time is our friend. So when we buy something, as long as we hold on to it for like 8 to 10 years, usually the historical returns on companies that are decent companies will be okay. However, when we're momentum trading, all right, we have to use stops, use risk control, because if the trade goes against us, we may not want to be an investor in the particular stock that we have chosen to make a momentum trade on. I mean, how many stocks can you think where you traded? They're under $5. They might be great momentum movers at this point, but they're not great investments. So you don't want to hold on to those. You got to get out when they go against you. So let me just see some of the other answers up here. Way to limit losing trades. Great, Rebecca. And of course, you know, you want to keep your losing trades what? Small, right? And your average losing trade should be less than your average winning trade. So we're going to cover a little bit about how to look at that and work on that. All right, Dana says, know where you're at. Okay, know where you're at. In other words, if you take a long trade and you're trying to catch a trend and you get stopped out, your stop should be at a point in the marketplace where there's not a good enough reason any longer to be long. So what she's saying here is you're going to know where you're at. In other words, if the trend or the momentum trade didn't go in the direction that it was supposed to, you want to get out, reassess, find another market perhaps, and then go again. All right? John, only seeing a quick pull box. Okay. I don't know exactly what that means. Is everybody seeing the screen here? Okay, I don't know. John, maybe log out and log back in. That may reset things. All right, Neil, the math has to work for the probabilities. Absolutely, and we're going to cover quite a bit of math here in just a little bit. Okay, visual is good. Okay, good. All right, so do we agree or disagree that we need risk control? Is it something we think we need? And if you're not using it, all right, don't be bashful. Tell me why you're not using it. Maybe you just don't know how to use it, but maybe you've had a bad experience with risk control. All right, so Neil completely agrees. Mako agrees. Don't know how to use it. Okay, well, good, Dana. That's what we're gonna show you here. Agree. Okay, so I think you can see that it is necessary, and as Rick says, it's absolutely mandatory. And it really is. It really is mandatory that you use it, because if you don't use it, it's just going to be a matter of time before what? Before you have a couple of big losses that are really tough to recover from. You know, one thing I want to just quickly mention here, you guys ever see those trading contests out there offered, even offered by some brokers? You ever see those where they offer these contests? Yeah, okay, good. Because it's funny, you know, I see them too. And the people that really win those are the people that go for broke. In other words, they'll do incredible option plays that they would really probably never do with their own money, at least they shouldn't. And yeah, when they win, they'll take the jackpot, but when they lose everything. All right? And so you don't want to trade like that. You don't want to do that because it's kind of like playing the lotto. That's gambling. All right? You're just going for broke at that point. So you really want to have a systematic way in which you're entering and exit the market, and that's your trading approach, and that's you know, how you set stops and so forth. But then we also want to talk about the mechanics behind risk control, okay? So let's go ahead and move on here. All right, so now fact, some losing trades are a normal part of this business we're in. So if we're going to lose a certain percentage of time, then we have to know how to keep those losses as small as possible so when we win, our wins dwarf our losses, at least on an average. So let me ask you a question. What do you think is a pretty successful percentage of wins for a trading system? Let me ask you guys out there. What do you think? 50%, okay. We try for better than 50. 60, that's pretty good. 35 to 40, hopefully not. 70, possibly, sure, if you're really good. 60, 60. 7 out of 10, of course, and 70. Depends on the risk reward. We'll cover that. 99, 60. Okay, so we have quite a few responses that cover a wide gamut of what people think are appropriate percentages. Believe it or not, the statistics show about 60%. If you have a trading system that is 60% accurate, so you're winning, your win ratio is 60%, you can do very well provided, all right, you have at least a 1-to-1 payoff ratio. Now in trading, we try to get that payoff ratio higher. That's the goal. But the payoff ratio is and we're going to discuss this in greater detail, is basically telling you how much you win versus how much you lose in a ratio, okay? So that depends, all right? So the percentage is only 60%, and this shocks people because, you know, if you read a magazine on trading or something, you'll hear about systems that are right about 80% of the time. But, you know, that's really a fantasy because consistency is what counts. And over time, they aren't really right 80% of the time. Very few systems are. Some of the master traders maybe, okay, but for the most part, that's a pretty difficult task to do. So 60% is pretty realistic, I would say, in this environment. Now, there's times when you may win 80%, but what we're talking about is consistently. All right, so your goal, all right, and what I want to try to emphasize tonight and show you some techniques on what to do is to keep your losing trades small and let your winning trades run. And so in order to do this, you're going to have to develop a systematic approach to money management and risk control. Now, when we say let our winning trades run, what does that mean? Well, it means that if you're a trend trader, for example, you want to stay in that trend as long as possible. And when I say that, what determines as long as possible should be your trading rules or system, not your emotions. Usually your emotions will yank you out of trends way too soon. Because if you're an emotional trader, you're always trading your last trade, and depending on what happened on your last trade will usually depend on when you get out of your next one. So letting your winning trades is a function of your trading approach, but also it's a function of your stops and so forth. And so we'll talk a little bit about that as well. Now, keep your losing trades small. When it's time to exit, emotionally, just don't think about it. Exit, okay? But also, too, there's something called trade size, and we want to talk about, you know, when you make a trade, how big should your position be? What factors could affect that? So we want to talk about that, okay, today. So there's a couple of variables we're going to take a look at. Tony, if you can't see the screen, I think log out and log back in, okay? Best thing to do. All right, so how do we do all this? Well, we calculate the trade size for each trade, and then we also need to know that your percent to risk on each trade. And your percent to risk is going to be a function of your trading results, your performance. We have a couple of pieces of software we're going to talk about tonight. One's called the Trader's Assistant. This is a record-keeping system, but it's also pretty slick because it's got the formulas built into it that delivers the amount or percent you should risk on each trade based off your actual performance. Then you use this percentage in another piece of software we have called the Trade Size Calculator. The Trade Size Calculator will calculate your maximum trade size that you should be taking on each and every trade. And we have it for stocks, futures, and our new Trade Size Calculator Plus, of course, is for the Forex market as well. So these functions, we're going to go over all this, but we're going to focus on these two pieces of software that work with any trading system and any trading approach that's currently in use that you're using. All right, money management. I want to come back to some basics here. Money management allows you to be wrong. It helps control risk. I think a few of you had mentioned this before when I asked my previous question. Takes into account that every trade can be a potential loss. Separates really the pros from the novices. Okay, it's the door that separates the gamblers from the professionals. It really is. All right, and it's really a state of mind. If you don't think you need money management, you're never going to use it. All right, and usually what happens, especially to new traders, is when they start out trading, is they really don't understand money management, and they go into the markets, and they go in, and then all of a sudden, they have a big loss. And sometimes that loss can be so big that it's quite devastating and can actually remove them from the market permanently. So you don't want that to happen, but usually a large loss teaches you a lesson. And it teaches you a lesson that you have to control that loss. And that's where risk control comes in. But unfortunately, a lot of folks have to get hit in the pocketbook, so to speak, before they take this seriously. What we're trying to do here tonight is get to you before that happens, okay? All right, so let's talk about some important elements of money management. All right, one is how much do you risk on each trade, both in a percentage amount and actual trade size, all right? So we need to calculate. How do you calculate that trade risk? Well, we use the Trader's Assistant. How do you calculate trade size? Well, we use the Trade Size Calculator. Risk management, what is that all about? And the risk of ruin, well, we're going to talk about that because all these types of formulas are built into these pieces of software. Effective stop loss placement, that's going to be up to your current trading approach. Now, we could spend a whole hour talking about how to set stops, but I'm going to assume here tonight that you have an effective stop loss placement program in place, and if not, then you should contact us because we have software called the Applied Reality Trading Software that does an excellent job of calculating where you should put your stop. All right, what I want to do here is and I want you to basically think to yourselves on this question. What causes traders to not use money management and risk control? And then I want you, each one of you, to personally think of an experience where you suffered an excessive loss because you did not use risk control. Then I want you to ask yourself why you didn't use it, and you may just have simply not known it existed, all right? But more importantly, what did that feel like when you had a huge loss? A couple of you respond in the questions area. I want to know more about what the experience felt like. Because when I first started trading, I had a huge loss, and it was not a lot of fun. It took me almost about a year to recover, not only financially, but emotionally too. And it can really set you back. So I think it's important if some of you panic. Yes, Neil, very true, panic. It was terrible. Almost feels like, you know, if you have an open position, all right, and the position is either too large, so you're out of your comfort zone and it's not going in the right direction, you're going to have a hard time sleeping that night. All right? And then what happens is as the loss can grow the unrealized loss can grow to a point where then it becomes so large you don't even want to take it. How many have experienced that? Okay, all right, and that's when you become an investor versus a trader. But then you become an investor probably in a stock that's not worth investing in. That's the problem. So when you're talking about short-term trading, it really is a zero-sum game in terms of there's winners and losers, and you have to have risk control to get you out of situations like this, okay? So let me just go through some of the responses. It was terrible, panic, okay? Guilt lingers long after the event like a scar. Isn't that true? I would rather get kicked in the head. I hear you, Tony. Crushed that I acted in an emotional manner rather than from a position of calm trading wisdom. Sure. I get out too early due to fear of loss. Yes. Diana, that's also too probably you kind of thinking of trades you may have just traded like the day before or the month before where you saw the same kind of pattern and you didn't get out or you got out too soon, whatever the reason was, and the market reacted. So the next time you trade, you do the opposite, thinking that's the right way to go. But of course, what you're doing there is going to be bounced around like a ping pong ball. Instead, what you need to do is you need to worry about and look at consistency. In other words, is my trading rules, if I play them time and time again, going to give me the edge? Kind of like you want to be like a casino, a casino house, not the player. A casino house where you have the edge, okay? Because you're never going to know what trade is going to actually work or not. All right. Let's see. I'm now secure of my approach. So when the big trading loss occurred, I took the time to learn how to handle it. Good. It is an education, but it can be an expensive one. Got to overcome the fear. When the market doesn't move quickly in my direction, I panic and get out. Took a long time to rebuild confidence. Okay, those are all honest and legitimate answers, and I think all of us, nobody's born a great trader, but all of us when we start out have felt that, and it is a terrible feeling, all right? But the idea is sometimes it takes something like that for us to be proactive to learn how to guard against it the next time. So let's go through this, and I'm hopefully going to be able to show you some concepts here that will help you. All right, so healthy money management, psychology that is, begins when you truly realize that each trade's outcome is unknown. Now, as traders, we're very optimistic when we go into a trade, or else we wouldn't go into it, right? But also, too, we also know this is a game of probabilities. So because it's probabilities, nothing is certain. And because nothing is certain, we know that each trade has a potential to end up as a loss versus a profit. So as soon as you realize that, then obviously you're going to start using risk control. That's a really important part of it. So it's really a mental psychology shift in your mindset that really starts you down the path of using risk control. So profitable money management occurs when you truly believe that you need it, plain and simple. All right, now, before we get into some of the math formulas and all that kind of stuff, I want to talk a little bit about trade risk versus market risk. Can anybody just kind of take a guess of what the difference is? Because there's a difference. Trade risk versus market risk. You guys are doing a great job out there today. All right, here's some answers coming in. Trade risk is you and the market risk is them. Well, that's not so wrong, Jeff. That's pretty much right. The other is unexpected market change. Not a bad answer either. The risk of a single trade. Okay. All those answers are right. Let me just talk to you a little bit about some of the definitions involved in this, in the trade risk versus the market risk event. So trade size, when we actually go into a trade, all right, we actually can control the risk in that trade, the trade risk, okay? We call it the trade risk because this is something we can use formulas for that will deliver the proper trade size based on our account size, based on our entry, and based on where our initial stop loss price level would be, okay? So we can control trade risk. We can control that. And we do that through risk control. The other kind of risk, market risk, guess what? The only way to control that is by funding your account with risk capital. Because in a market risk scenario or event, it is something that is usually somewhat beyond comprehension in the normal calculations of trade size. For example, let's say you wake up in the morning, you place your trade, you're very careful, you calculate your trade size, so you get your trade risk in hand, and all of a sudden, boom, we get a terrorist attack. Markets go crazy, gap down, way past your carefully chosen stop, and all of a sudden now you've got a much larger loss than you calculated for. That's market risk. You can't avoid it. It's always somewhat there. The nice thing about market risk, it doesn't happen that often. The bad thing is when it does, it can be pretty bad. All right. However, if you still use the guidelines that we're going to teach you today on calculating your trade size so you can control your trade risk, what usually happens is when you have a market risk event, you actually can recover from that pretty easily. It's a setback, not a devastating problem that can occur if you don't have the proper trade size. In other words, your bet's too big. Then you're going to take a huge loss. It may not be recoverable. So market risk, if you want to really control it in any form or fashion, you do it by funding your trading account with risk capital. So we call that account size. This is why even if you're a very, very good trader with a very, very good win ratio and payoff ratio, you still don't bet the farm, okay? You still don't bet the farm, so to speak. In other words, you don't fund your trading account with your entire net worth. Does that make sense to everybody? Does everybody understand the difference? Okay? Because these are two things you got to take a grasp of. And as traders, you know, we work in a realm of probabilities and we control what we can, but there is some things we can't control sometimes. Okay, good. All right, thanks, Ed. All right, so let's talk a little bit about risk of ruin. All right, what is risk of ruin? Anybody? What is risk of ruin? Think of a coin toss. Lose it all, okay? We're going to show you how to make it work for you instead of against you. Probabilities, yes. All right, so let's take a look at some risk of ruin tables here. All right, first thing before we do is I need to talk about win ratio and payoff ratio. So how many trades do you win versus how many trades do you lose is the win ratio. We talked about this briefly already, but I have to make sure you know this before we talk about risk of ruin. All right, payoff ratio. How many dollars do you make for every dollar you lose? Okay, these are two very important aspects that you need to know about your trading. All right, the win ratio formula. Win ratio is the number of wins divided by the total number of trades. So if you're 60%, like we talked about earlier, all right, basically that means you're winning 60 out of every 100 trades. Short term, maybe 6 out of 10. Pretty easy, right? Payoff ratio, the formula is the average winning trade divided by the average losing trade. So it's usually a formula, something of that nature. So 3 to 1 means you're winning $3 for every $1 as an average, okay? All right, now here's a nifty chart, okay? And this is a risk of ruin table taken out of one of my books. And also I've got permission to use this table from another professor, Nasser Balsara, okay, who's pretty good in this stuff. All right, and so he let me use his table for my book as well. But the point that I'm proving here on this is that there is a direct relationship between payoff ratio and your win ratio. In our example here, okay, the risk of ruin probabilities, if you have 10% of capital at risk and you have a payoff ratio of 2 to 1 and you're only winning 55% of the time, okay, then you have a 0.2% chance of going bust, all right? That's not a lot, okay? Not a lot. If you were winning 60%, which is right below the 55%, and you had a payoff ratio of 2 to 1, that almost goes down, that goes down to 0, okay? Notice if you have a 45% chance, win ratio, and a payoff ratio of 1 to 1, you got a 100% chance, okay? Because you're losing more than you're winning, and your wins and losses are the same, okay? So it's kind of a neat table. All right, you're seeing the poll. Somebody says they're seeing a poll. Okay, well, let's see how. Hopefully, is there a place you can close the poll? It looks closed. It's closed on our end, so hopefully you should certainly have that closed on your end. Okay. No poll here. Okay. Again, I guess log out and log back in. I don't know why that's happening. All right. So here again is another example of a payoff ratio, like I mentioned before, 45%. All right, puts you in the red. Okay, 100% chance of going bust. So it kind of gets you to see that there really is a relationship between the two, the payoff ratio and the win ratio. They're kind of married, aren't they? So I think it's important to understand when you trade what your payoff ratio is and what your win ratio is. So you need to be aware that the risk of ruin is possible. And so if you're trading at 50% and you've got a 1-to-1 payoff ratio, you've got risk of ruin problems, don't you? All right, if you're at 60% and you got a payoff ratio 2 to 1, you're going to be okay. All right, so you need to have this awareness when you start looking at a money management strategy. Okay, so now the next thing we want to talk about, most people have heard like don't risk more than 2%, okay, which is a good rule of thumb for a system that's winning about 60% of the time with a payoff ratio that's above that. So that's not so bad, all right? But risk control is based on the risk of ruin formulas, which use your actual performance to calculate your percent risk to arrive at the correct maximum trade. We use this in the trade size calculator. I'm going to show you. The trader's assistant, all right, calculates your percent risk that can be inputted into the trade size calculator. Since these formulas, which also include optimum F calculations, etc., are built into the trader's assistant. So it delivers a percent to put into the calculator, all right? Now, one thing that we've observed is when we talk about trade size, okay, this is how large your bet is. And trade size, if you're trading stocks, is shares. Trade size, if you're trading options, is contracts, all right, or futures is contracts. In the Forex market, it's pips. So when we talk about trade size, it's the number of those in which you were going to buy, okay? So novice traders usually trade the same trade size on every trade size. In other words, when I do consultations, one of the first questions I ask the trader is, do you trade the same amount of shares on each and every trade? If they answer yes, then I know I need to look a little more carefully at their risk control model, because chances are if they're doing that, then they're not using the proper trade size on each and every trade. So if we take a look at the trade size calculator, all right, the trader's assistant once again shows you the percent risk to put into this box here, 2%. And this is based off your performance. Okay, so whatever your performance is based off the trader's assistant, that can go into the percent risk area. All right, so let's do an actual question. All right, so this is a question on trade size. We're going to assume that your percent risk is 2. So we're going to give you some variables down here at the bottom. So I'm just going to take my pen here and show you where these variables are down here. All right. So the account size is 50,000. So if we look at that.
Hey, Ben?
Yeah.
Ben?
Yes.
I don't think the slides are advancing.
Oh, okay.
The slides are not advancing.
All right. Well, thank you for telling me. Okay. Let me stop the screen sharing, and we'll start it again.
It stopped advancing after the risk of ruin with the red markings.
Okay, well, that's okay, because this is really The other stuff I explained, it was just a verbal explanation. So we'll start here. Is that okay, everybody? You can see this okay now? Let me know if you can't. Okay, good.
Yeah.
All right. Gene, let me know if that happens again, okay? All right, yep. So here we go. All right. So in this case here, this is basically we're gonna show you how we use the trade size calculator, and then we're gonna show you some formulas that are inside the trade size calculator. So if we look here, notice some of the givens in this trade. We got an account size of 50,000, so we put that in this little area here, okay? Then we got the percent risk of 2%, so we put that in here. And then we got our entry of $26.99. So in this example, all right, we're assuming that, okay, we got a breakout system, so we're going to go long if prices get above this key level of resistance at $26.99. Now, I know some of your trading systems may not work like this, but you'll still have an entry level of some sort that you'll have to act on. So whatever that entry level is, that's what you're going to put down as your entry price down in here. And then you have an exit price of here. Now, when we talk about an exit price, all right, this is a potential or initial possible stop loss level. And basically what we've used here is a level of support, the most recent level of support at $25.45. Your trading approach, I don't know what you're using, but it may actually give you a certain dollar amount, okay? But you need to know what your exit price would be if the trade fails. That's the point. All right, you may not ever get out here, but if it does fail, after you go long, if it goes up here and comes back down and stops you out, we need to know what price you're going to get out at. And in this example, it's $25.45. Then we set the commissions. This we're using just a $10 as an example. This is based off the stock market. So we're going to have a point value of 1. That's how we calibrate the calculator. If you're using, for example, the S&P E-mini, you'd put 50 in there and switch it to futures. And we're using a margin account. All right. So then we hit calculate, which is this button right here. And it's going to tell us we can go long 642 shares. And if we get stopped out at this level here, our loss is going to be $998.68, which is 2% of 50,000. Now, don't get confused with thinking that 2% of 50,000 is $1,000 and you're only going to be trading with $1,000, because that's not the case. You're going to be trading at 642 shares times, okay, $26.99, right? Because that's how much your buying powers you're going to need to do that. So the actual amount is $17,327.58 is going to be the actual amount of cash that's going to be used in your account to make this trade. All right, so let's keep going on here and see a little bit more. All right, so we did all this calculations here, and here is the actual formulas that are built in to the trade size calculator. So for example, step 1 is calculating your dollar risk amount. So if you have a $50,000 account, which we gave you as the given, and we also told you 2% would be the risk we'd use in this example, then 2% of 50,000 equals 1,000. That's pretty easy, okay? So that's the first thing you want to solve for, is the dollar amount of risk. Then the next thing you want to take a look at here, all right, which is step 2, is actually calculating your trade size. So you take the risk amount, which is what we calculated earlier. That's your $1,000. So you take this from step 1. Take your commission, because we want to try to get an accurate net figure. So subtract that out. And then the difference between the entry and the stop was $1.54 in this example. Divide those and you get 642 as the shares. So if we go back to this example here, All right, we just put all these variables in the calculator and hit calculate, and that gives you your maximum trade size. You don't have to trade that big a number, but don't exceed it. Okay, that's the key thing, because then your risk is going to exceed $1,000, and based on your performance, you don't want to exceed a 2% loss. And here is the answer, 642. All right, here's a question for you to see if you got it. All right, if the distance between your entry and exit is closer than 575, what would your trade size be, larger or smaller, or the same? If the distance between your entry and exit is closer, larger, okay, anybody else? Larger? Well, you guys are good. Correct. So in this example here, all right, here's your entry, and here is your exit. All right, this is based off one of our trading methods called the pyramid trading point, where it identifies your entry at the top of the apex or the pyramid and your stop at the bottom. So your risk, your physical risk between the entry price and the exit is 575. So what we're saying in this example is, if this distance was not as far apart, but let's say closer, like $3, then your risk would be less and it would allow for a larger trade size. So you're right, guys, okay? And basically when you put all these variables in the calculator, and this is a futures market, all right, so you put the margin in there too, then there's your trade size. It's 3 contracts, okay, based on this example. All right, so the idea is that no matter what your entry or exit is, all right, the trade size calculator is going to still deliver the right trade size, because that is the variable it's solving for, while keeping the percentage a constant 2%. All right, so that's calculating trade size. But now we have to switch gears a little bit and go to something equally as important, and that is what, of course, is record keeping. How many people out there keep pretty good records of their trades? And don't feel bad if you don't. Not great, okay, somewhat, no, yes, TS printout, I don't, so. All right, you really should, because this will force you to see the reality of your trading and avoid any denial issues, okay? Record keeping really will strengthen your trading psychology by enabling you to look at your trading results in a detailed way. It's really important. And I'm going to show you the Trader's Assistant and show you what we use to organize our trading. I'm going to show you a little bit about how it works. All right, so here's the Trader's Assistant on the left-hand side running side by side with the trade size calculator. Okay, so this is the trade size calculator, right? Call that the TSC, and this is the Trader's Assistant, TA. All right, so these are programs that run right on your computer. Okay, it doesn't matter what charting platform you have or anything of that nature, but that's where it runs. And the Trader's Assistant has a worksheet, an open trade tab, and a closed trade tab. And the neat thing about this is the worksheet is where all your trades go, for example, that are pending. They have not been filled. So any trades that you have pending, whether you're day trading or position trading, can go there. When they're opened, filled, then they go into the open trade center, and then when you close, they go into the closed trade center. All right, when we fill out an actual entry, we use a trade posting card, just like they do on the floor, okay? And in the trade posting card, you've got a few elements here. One is you've got the card information, which is kind of cool, because what you can do is you can go, and I'm going to show you this soon. I'm going to show you how you can pick out any card at any time on the ledger and get a detailed report on that trade. And it gives you a place to keep notes on the trade for what you did right, what you did wrong, all right, etc. All right, trade exit details, etc. This will run on a Mac provided you have Parallels, Mark, or something like that running on it, okay? Most of the Macs have that now. So pending order, you put the pending order in here. This gets it on the worksheet. When it opens, you click it open. Sometimes the pending order price, all right, will not be the same as the actual execution price. So you always want to put the actual execution price on here, okay? Let's go on. Here's the exit portion. We allow for 3 different exits, okay, for scaling out. All right, then the system automatically matches the exits with the original lot, okay? You can also paste potential stops that have not yet been hit up here, okay? So you can keep an eye. So when you have a trade posting card that is open but not yet closed, so you don't have any of this information down here filled in yet, you only have this information, you can go to the trade posting card and check and see what price the stop's at. Okay, and then when it actually fills, you fill it in here with that. Notes. This is where you can put notes in, okay, about your emotions or specifics about the trade, okay? If you keep good notes on each trade, you'll start to see some patterns form, okay?
Hey, Ben.
Yeah?
Roxanne would like to know if you can add a chart to the note keeper.
We'll see. We've made some additions to it, but I don't think you can. All right, so let me go through. Let me keep going. Okay, this is the scorecard here. And this is one of the most important parts of it. This will give you the information kind of like what we talked about before, right? The win ratio, the payoff ratio, commissions, okay, largest loss, largest win. Everything you need to know is automatically calculated when you automatically close out a trade, so you don't have to do it manually. Open trades. This is kind of a great feature. Think about if you have, whether you're day trading or position trading, you know, things can get hectic and you can sometimes forget what you have open, all right, especially, okay, if you don't have your broker's window open. So this will give you a great quick check to see what trades are open, all right, the entry price you had it, all right, and the number of units, whether it's shares or contracts, and the gross amount paid and commissions, all right? So it gives you all that information out on the open trades. So think of the open and closed tabs as really what's out there. The open trades are open but not closed. The closed trades are your actual performance. The worksheet is stuff you're trying to get in but you're not filled yet. Now on the closed trades tab, all right, we have a couple different things. We have the ledger, scorecard, utility, equity curve. We also have the risk of ruin calculator. So we're going to take a look at that as well. And this is the risk of ruin calculator that gives you takes your win ratio and your payoff ratio from your current performance and then gives you the percent that you should put into the trade size calculator. And it does it automatically, so you don't have to figure it out. Also gives you your equity curve. All right. What I want to do here is I'm going to come out of PowerPoint really quickly. So give me a second here. All right. And let me just open up my trade size calculator here. Okay. There it is. All right. And you can see here, all right, this is the ledger for closed trades. Okay. This is the scorecard, okay, so if we started out in this example with a $75,000 account, and let me just grab my pen, all right, so this is the account size that we start out with. You have the scorecard. We're looking at the tab of the scorecard. You have a net P&L of 5,786, a total running account size of 80,786.40, simply adding the 5,000 to the initial account size. All right. Payoff ratio is 1.42, win ratio 58. You've done a total of 85 trades, okay? And so it gives you your percent P&L is 7.22. And so that gives you the figures right there. You don't have to do any of the calculations. All right, if you go to the equity curve, that's what the equity curve looks like. All right, starts it at 75, moves it on up. Risk of ruin on this particular basis would be 10%. 58, you got a 1.42, okay? So that just kind of gives you an idea of the closed tabs. You got notes, all right, here. All right, you can print the notes, you can print things here, but that is kind of what it's all about. Open trades could go in there. Again, equity curve. You can also, there's ETFs, okay, and stocks you could put. You also have an options box here where you can actually preset some of the defaults. And complete instructions on how to use this are included by just simply clicking on the help button. You also can, the default database, all right, is in a nice shared file on your hard drive, so it automatically puts it in there. But if you want to move it around, you can do that and reset the database. You can clear it. All right, simply all you have to do if you want to copy the database and use it on another computer is you just go to where the database is stored and copy the traders.mdb database file, and you can copy it on a hard drive, a disk drive, or anything like that, and move it to another computer and just use it. All right, and then install the Trader's Assistant on the other computer, and we'll just pick up the data that you've installed. So it's a really slick tool, works great. We use it all the time, and let me just also show you here that we have, I'm going to give you a link here. I'm going to do it in just a little bit where you can read more about it, but it's a great piece of software that will organize your trading. And also the nice thing about it is it will allow you to also check your broker statement, okay? So that's important. So if you have questions on your broker statement about something that doesn't quite look right, we'll look and see how you entered it on the actual Trader's Assistant as well. All right, so now we're coming to the end of the webinar. So the next question is, all right, how can I take this information and make it work for me? All right, so we got some immediate action steps. You should now have an idea of how important it is to calculate your trade size on every trade. And now you should actually know how to do it. All right, you need to also, if you're not, you need to also have trailing stops and an initial stop when you take a trade. So if you're using a system that does not give you an initial stop loss, in other words, sometimes, for example, if you use a system like that uses a stochastic crossover, you may not know when you're going to get out of that market because you wait until it crosses back over. All right? So what we'd like you to do instead is kind of add another level of protection to that kind of trading approach by coming up with a critical price level, a critical support level in the market where you know you need to go out and use that as your initial stop loss. So that's something immediate action you can take at this point, okay? All right, so how do you calculate your trade size? Well, you can use the trade size calculator or use the formulas that we showed you. All right, and then use, of course, the key level of support for stops.